welcome to Traders Corner. Joining me, as always, is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, you're not wearing a bear suit, but to all intents and purposes, you might well be, because we're going to go through a host of charts this evening showing just how, I suppose, fragile the markets are. So let's start off with the volatility index, which must be doing very interesting things at this point.
It certainly is. So the volatility index, we call it the VIX. It's the Chicago Board Options Exchange Volatility Index. And this is a gauge of implied volatility on S&P 500 options, index options. And it's kind of also referred to as Wall Street's fear gauge. So when volatility spikes, then often that happens at time of market panic or market fear. And when volatility is low, that's when markets are relatively complacent. Now, what's interesting is have a look at this VIX index that's on the screen now. This goes back to 2011. And I'm going to show you a longer-term one as well now. But just notice how we've got this massive big rounding bottom happening on the VIX here. And how since the beginning, or middle of 2014, really, and into 2015, you've had rising bottoms on this VIX index, implying that volatility has gradually been picking up, implying that there's more and more nervousness and more uncertainty in the market. Now, if we go back even further, now this slide goes back to the beginning of the decade. In terms of the VIX index. So you can see two very clear patterns over here. The one now, that's the 2003 to 2008 bull market. And notice how towards the end of the prior bull market, the VIX began to tick up. And it was warning you that there was uncertainty and discomfort in the markets. And eventually it ended with this massive volatility spike, which was the 2008 and 2009 financial crisis. And in fact, I've earmarked all the different spikes over here to show you what they were. So that one, as I said, was the financial crisis. Then we had the flash crash in 2010. In 2011, there were all the fears around Greece. And then most recently, we've had a spike up in VIX when this Chinese stock market crashed in August last year. But what's very telling for me is this big rounded bottom and the fact that volatility levels are increasing. And that is a sign of increasing nervousness in the market. And invariably, bear markets will be more violent towards the end of a bear market than during the beginning phases. And I would argue, looking at this VIX, that the bear market that we're currently in equities still probably could have a lot more violence and be a lot more nasty further down the line, because I think we still need to have that massive big blow-off in the VIX like we saw in 2008.
Well, funnily enough, before we went on air, we were talking about Deutsche Bank and the global bank shares and how they are looking very, very shaky, well, as far as the market is concerned, and maybe this could herald, the next crisis.
That's it. There's lots and lots of things out there that are worrying, and we're going to look at a few more slides here to illustrate what, just the sense of nervousness in markets at the moment.
Well, everyone's been fleeing into haven assets, and gold is among them, and look at that chart there.
That's it. So here we've got the gold price in dollars over the last 6 months or so. And what's very evident is that since the middle of December, we've seen a massive spike up in the gold price. And you can see that this has gone parabolic in the last 2 weeks or so. The gold price is up 15% in dollar terms in the last 7 weeks. Now, you've got to say to yourself, why? What's the reason for this? Yes, the dollar has weakened very marginally over the last week or so. But nothing like enough to warrant a 15% gain in the gold price. And to me, the only logical explanation that I can come up with here is that this is another example of people fleeing to safe haven assets, and gold is perceived as a safe haven in times of market turmoil. We certainly saw gold strong in 2008, and it looks as if gold has now suddenly gained a whole bunch of appetite once again. So another warning sign on the horizon, as I see it here, the gold price.
Now, that's kind of, I suppose, an obvious chart to draw up. But what you've pulled up, got there next, is an ETF on American utilities. So talk us through that chart, because that's really interesting.
Yeah, I've noticed from looking at a lot of overseas markets, and I look at the London market quite a lot, but also the US markets, and I've noticed that generally the defensive stocks have been doing quite well. So companies like, for example, Unilever in the UK has been doing quite well, and they make, just things that you use around your home, which we're always going to need, irrespective of the economic climate. And that got me thinking, what about the utilities? And I'd heard commentary about utilities generally doing okay on the New York Stock Exchange recently. Now, I found this exchange-traded fund, the code for it is XLU, and it's the New York Stock Exchange Utilities Sector ETF. Now, what utility stocks are basically things like electricity companies, gas suppliers, companies that supply things that we all need in our homes and offices always, irrespective of the economic climate. There's a very inelastic demand in terms of what these companies supply. And again, look at how strong this utilities ETF has been. We've seen a big breakout to the top side here recently, but notice since the middle of January, this utility sector has really put on some big gains over the last 2 weeks or so, and it's broken out. And again, these are not exciting businesses. The utilities have got to be some of the most boring companies in the world.
Well, unless you're Eskom, I suppose.
Yeah, exactly. I suppose Eskom is an exception. They're always full of excitement for us, not always for the right reasons. But utilities companies, globally speaking, and particularly in developed markets, they are very boring companies. Why would we suddenly see a massive surge into these types of companies? And once again, I view it as a flight to safety. These kind of companies are going to continue to churn out profits, and they're going to continue to do business, irrespective of the economic climate. And it looks to me as if we're seeing money flooding away from some of the other sectors of the market and into this utilities, into gold, these types of things which are perceived as safe havens during a time of market uncertainty.
Garth, I mean, you've pulled up quite a few charts so far to illustrate nervousness in the market, but what's happening to sovereign yields is also very important. The Japanese government bonds went to zero, I think even negative at one point today, and US Treasuries look like they might be following suit.
Yeah, very much so. The US Treasury is very interesting to look at in the context of that. And you can see that over the last couple of weeks, right, basically in the last 5 weeks or so, the US 10-year Treasury note has gone from yielding 2.3% down to the current level of 1.7%. And you can see that massive, massive drop there. Now, keep in mind that Treasury yields trade inversely to the price of the yield of the Treasury, or the bond in this case. So what that implies is that there's a massive flood into bonds, buying of bonds that are pushing the bond prices up, and hence the bond yields are coming down so aggressively. But I mean, what this is, in effect, what this means is that you're going to lend your money to the US government for 10 years, and you're happy to accept an annual yield of 1.7% on your money. I mean, that's how low it is. And one's got to then ask yourself, is that perhaps pointing to a potential deflationary scenario? And I've seen this theme gathering a bit of traction. I know George Soros got a lot of airtime for it because at Davos he talked about the one thing he's pretty certain of is that we're moving into a deflationary world. And when you look at the way bonds are trading, you've got to think that there's probably some merit in that thinking. And this is also another sign of nervousness globally.
Okay, so this is the global picture. Of course, we're not immune, although there are some factors that play out on our own markets, I suppose with any other markets, the Rand being one of them. But what is happening to the top 40 index?
Yeah, I want to bring it home and just basically hone in on our top 40 index again, because we often look at this. Now, we've dealt with this chart many, many times, and I'm looking at it again. Really, you can see the top 40 there over the last 2 years tracking along mostly sideways in a very volatile range. But this lateral support level at 41,500 is a very, very important and very significant support level. And my concern is that we've tested it so many times and bounced and come back and tested it and come back and tested it. We've now been in a downtrend over the last couple of months. And my fear is that we may very well be moving back to test this 41,500 level again. And possibly at some stage, I suspect we're going to break below that. When a support level like this gets broken, gets tested so many times, eventually it does tend to break to the downside. Now, I want to zoom in on that area that I've put a dotted line around, or the box around there. And what you can see here, now this is the last 4 or 5 months of trade on the top 40 index. Notice we sort of had a small peak in late October. November we were weak. We had a bear flag rally in December, which broke to the downside. And now it looks to me as if we're potentially making another bear flag type of structure here. If we start to break to the bottom of this bear flag over here, which would come in at around about, say, below 43,500 on the spot index, then I think that is going to probably open another leg back to the prior lows, back to that area between sort of 41,000 to 41,500. And the concern is that, obviously, as I said, we keep testing that support level. At some point, I fear that we're going to break it.
Garth, what might keep us from that, or from testing that and breaking below it, is what we've seen in the resources index lately? Or do you think that's not enough? And in fact, maybe what we've seen is just, I don't know, a bit of maybe a short squeeze or a bit of a spike in a continual decline.
Yeah. My feeling on the resources is that we have seen a very violent short squeeze. I don't think that the worst of times are over for the resources stocks yet. Look, it's possible that we might have seen a low. I don't know. But But I don't think that the trajectory of the moves up that we've seen in the resources sector is just going to keep on going. I think it's done too much too quickly, and the likelihood is that we will retrace a fair chunk of those gains. And I think resources are probably going to put in a big volatile basing pattern this year. So I wouldn't be chasing the resources after the big run that they've had now. But what's interesting also to note is that in the context of the top 40, only 13% of the top 40 is now actually made up of resources shares, which is a very, very small number compared to what it used to be. And a lot of people still think that our market is very resources-based, and it's not. It's predominantly made up of industrials and financials nowadays.
Okay, well, you've got the industrial index up there now.
So for me, the industrial index is the more important one to chart. And what I want to look at here is the channel that goes back over the last 2 years or so. You can see it very clearly there on the industrial index. And what's interesting right now is that we've been making lower highs and lower lows since about October on the industrial index. It looks as if we're making another one of these bear flag type of patterns. And in fact, with today's market weakness, it looks as if we are breaking out to the bottom of that bear flag structure. And that, to me, would suggest that we're probably going to go have another revisit of the bottom of this channel on the industrial sector now. And that would come in at around about 63,000 on the level on the industrial index, which is about a 10% drop from where it's currently trading.
Okay, now does that depend on the performance of a handful of shares, not even Naspers, which is having a torrid couple of days, SAB Miller and Richemont?
Yeah, so SAB Miller is the biggest, the heaviest weighting in the industrial index, but because of the corporate action with AB InBev, that share price is going to remain elevated. So we kind of exclude that from our analysis. Naspers and Richemont are the other two that have a very heavy weighting in the industrial index. And together, those two stocks account for 35% of the weighting of the industrial index. So if we look at those two, because those are the two most relevant ones to look at when analyzing what's going to happen to the industrial index at this stage. So here's Naspers. What's interesting, it's not shown here, but the stocks, the 50-day moving average has rolled over, which points that your medium-term momentum is now weak. We've had, similarly to what we saw on the top 40 index, we had this rising wedge in December, which broke to the downside. We've now got a bear flag that's formed throughout January, and that is also breaking to the downside today. So my sense is that if you take the height of this flag pole and you project that down, it gives you a target of somewhere around about 1,600 Rand for Naspers. So, and the only way that I would negate that downside target is if we saw Naspers trading back up above 2,000 Rand per share. But if that doesn't happen, then I think we still got further downside on Naspers.
And Richemont, very quickly?
Richemont also. So we've got a descending triangle pattern that's been forming over here. These flat bottoms here come in at about 102 Rand per share. And the fact that we've got all these falling highs suggests to me that the higher likelihood is that we are going to break out the bottom of this pattern. There's a big gap over here, which comes in at about 100 Rand per share. But then there's all this lateral support down here at 97 Rand. And my sense is that if the share price breaks down, it's probably going to 97 Rand.
Garth, wrapping up everything, very quickly, your option structure, how does it look to benefit?
Yeah, so I mean, how are we positioned given all of this? Well, we do have our option structure, which we spoke about on the show last week. It works for us on the top 40, below 43,000, and we'll start making money, and that makes money all the way down to 38,000 for us. Okay. So I'm very happy to have that structure in place. And again, just plotting it on the chart of the top 40, you can see the payoff over there. Anything below 43,000, we start to look good. So I'm comfortable with the way we're positioned in the sense that we've got this, and then we've also got a short position on cash build at the moment as well.
Okay, so the portfolio is pretty much unchanged from last week?
Yeah, it's the same as last week. We've just got our option structure on and then this short position in cash build.
And then just very quickly to end off with your courses.
All right, so I've got another high probability course coming up in Cape Town on the 5th of March. Anyone that's interested in attending that, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Great. Garth, thanks as always. Garth McKenzie is founder and editor of Traders Corner.